As of 2020, China owns about $1.1 trillion of US debt. They are the second largest debt holder, ranking right below Japan. How did this start? Xi Jinping did not pull up to the White House with duffel bags of cash for the president. Instead, what China did was buy US Treasury bonds. A Treasury bond is a debt security that the US government sells with maturity ranging from 10 to 30 years. In simpler terms, if you give me $1 million, I'll give you a piece of paper that says you gave me $1 million. I will then pay interest on that bond every 6 months. On the maturity date, I will then pay you back the $1 million you gave me. The United States pays China approximately $74 million in interest every day, but China's economy has weakened slightly ever since the trade war began. Ever since President Trump applied tariffs on $50 billion worth of Chinese imported products, it has been disastrous for both sides. In the United States, prices have risen for consumers. For China, the trade war has slowed an already declining economic growth. But what happens if the United States goes too far? What if China begins selling all their US Treasury bonds to other countries or back to the United States? It is not that simple for China to hit the sell button. The consequences of selling all US Treasury bonds would be dire for the world. Let's start by talking about what would happen in the United States. Because of the sell-off, the bond market would be flooded with these treasuries. This impacts the US government's ability to issue new debt at a low interest rate. Since the United States government would be increasing spending in order to pay off these treasury bills, it would either need to print more money or refinance the debt by borrowing more money elsewhere to pay off the Chinese. Either way, the value of the dollar would begin declining dramatically, and the price of consumer goods will increase. This would make everything the United States imports more expensive. The US would no longer be able to buy from China, as selling the bonds would have made the Chinese currency stronger. In 2019, the US exported $1.6 trillion worth of goods and imported $2.6 trillion worth of goods. This means that the United States is somewhat reliant on other countries to provide for their consumers. In China, for a short period of time, everyone would be celebrating the fall of the United States economy. As time goes on, China will realize that depreciating the dollar was not in their best interest. The more they begin to sell off their treasuries, the value of the remaining treasuries they hold will start to decrease. As far as further trading goes, China exports 19% of total goods to the United States. Because of the weak dollar, the United States will no longer be able to afford to trade with China. This would mean that China would be bringing in much less money if they stopped trading with the United States. This would be an ironic situation as China buys US treasuries to keep their currency weak so that export prices are lower, encouraging global trade. In 2001, when China joined the World Trade Organization, there was an influx of Chinese goods in the United States. China had a comparative advantage in many sectors in which the United States could not keep up with. The US saw unemployment increase drastically, businesses fail, and no transition plan. We now call that period the China shock. Overall, goods became cheaper and more accessible to consumers in foreign countries, and China brought hundreds of millions of its citizens out of poverty. It fiscally does not make sense for China to start a trade war because although it would hurt global economies, it would all tumble down on top of them. What can China do instead? China has already placed tariffs on $75 billion worth of US goods. When announced, the United States stock market had tumbled along with the bond market. With that, China can simply stop importing goods from the United States. This would cause the US GDP to fall and slow economic growth overall. The United States cannot do the same to China as it needs China in order to sustain consumer growth. Another move the Chinese can make is interfere with US companies that work in China, such as Apple, Boeing, Nike, and many others. They can do this by levying taxes, increasing control, or simply kick them out of China. But this again would hurt China's economy in the long term. If China can slowly begin self-sustaining its economy and just stop buying US Treasury bonds, it can slowly wedge themselves out and bleed out other economies. But what does China have to gain from calling in their debt? Aside from a spot in the history books for causing a global panic, forcing millions of their citizens back into poverty, and bragging rights, nothing really. The likeliness that China calls in their debt is unlikely but never zero.